Trideep Bhattacharya is with us. He's a CIO at CIO Equities at Edelweiss AMC. Trideep, good to have you with us here. You heard my colleague Hormuz outlining that note. Just your impression, first thoughts on... I mean, the common consensus seems to be the only thing keeping... I mean, which could keep things, hold us back, hold the market back a little bit is the already sharp run-up we've seen valuations. Otherwise, you give it time and the runway is pretty good over the next couple of years.
Yeah, I think what at India Observer as portfolio managers, what we need to keep an eye on is basically earnings. As long as earnings come, markets are a slave of earnings. As long as earnings keep coming, you will see the markets do well. If you look at the last couple of years, and if you look at the earnings growth of India versus that of, and compare that with what you have seen globally, you would see that the relative earnings upgrades have been the highest in India. Likewise, while people complain about mid and small cap valuations, if you look at the last couple of years, the earnings growth of mid and small caps have really ratcheted up, and the earnings growth within India has become fairly broad-based, which is why you've seen broad-basing of stocks that have done well over the last couple of years as well. So the lead indicator to all of this, as I keep saying, is basically earnings. As long as earnings are doing well, whichever pockets they do well, it will follow investments not only within India but also globally.
Okay, all right. Hi, Trideep. Good afternoon. Good to see you in. Trideep, on this PSU banks versus private banks, where are you all placed? You know, one of them, which is the private sector banks, if someone told you some of these large banks you're going to get it at 2.2 times price to book, they look delicious and yummy. The problem is in the near term, there still could be some kind of a, a scruffle for deposits. While the PSU banks, well, they are looking pretty good, but maybe the ratios are hitting a peak out there. The credit cost, the ROAs. How would you go about things from here on? Would you be allocating money to both, or is there a preference?
I think over the last 1 year, we have increased our PSU bet with regards to not just within banks, but across a multitude of PSUs across different industries. Because in some industries like defense, I would argue that the PSUs are better positioned than some of the private sector players, because that's where they have been putting a lot of attention to. More specifically, within banks, we are at that stage of the cycle where asset quality concerns are hardly there. Lending growth is picking up from a small base. And hence, from that perspective, all the banks, whether it is public sector banks or private sector banks, are looking good. And in that context, the set of the banks which took the bigger hit was the PSU banks, and hence the growth rates and all of these things are looking well from PSU bank standpoint. And add on top of that the near-term issue that you mentioned, that from a loan deposit ratio position, they are the best positioned as we speak. And over the last year or so, factoring all of this in, we've actually increased our weightage in PSU banks, particularly towards the mid-cap ones. But if you ask me from here, I think from here the credit cycle begins. And as the credit cycle begins, the traditional framework of picking stocks within banks and NBFCs, which is the liability franchises, the ability to lend properly and still not incur losses, become more important from here. It will not be evident immediately, but over the next 12 to 18 months, I think that's what will probably rule the roost. And that's where we are actually kind of, focusing on. Incrementally, a little more selective within banks and NBFCs. Actually, between banks and NBFCs, we are a little more positive on NBFCs, because at some point in time, over the next 12-15 months, when rates do come down, they would actually stand to benefit from that. And hopefully we benefit from the same as well. So a long-winded, broader answer for your question, but hope it helps.
Trideep, afternoon, and thanks for joining in. What about real estate? We just heard, about Chris Wood. He has a 19% weightage in real estate, and he was one of those, the early ones who called this bull cycle in real estate. Now, the question is, off late, the cycles are getting smaller and smaller. Does the real estate cycle have a lot more steam left in itself? And, real estate is not one big sector, right? There are so many micro markets. Which one would you bet on? What's looking attractive?
Yeah, I would say that we are in the middle of a 5 to 7 year upcycle in real estate, and that is after almost a 10-year downward cycle that we saw, and after having seen a lot of consolidation driven by RERA and regulations like that. The first half of the cycle is kind of done where the builders have done really well. I think the second half of the cycle, where the ancillary sectors like building materials, tiles, sanitary ware, these type of companies haven't done that well. And as the later stages of the real estate cycle comes in, those are the areas where probably kind of, there is more alpha to be made over a period of time. But real estate as a sector is something that we have been bullish on for the last couple of years. And we've actually kind of, added on to that, particularly on the ancillary sectors over the last year or so, along with IT, which is what we have done over the last 2 or 3 months.
Okay, so that is the view on real estate. Trideep, hi, good afternoon. So technology, the buzz is all around NVIDIA. Of course, we have no direct plays, and that's not the kind of technology services that we have here, in India in the listed space. But what is your overall view? I mean, are you looking at the large caps anymore? And incrementally, sort of, what's the house position at this point in time when you're looking at tech as a whole piece?
So I remember last time when I came across and we talked about the yearly view, we said that IT services would be a dark horse of calendar year 24. And in sync with that, over the last 2 or 3 months, we've actually turned overweight on IT. It worked out nicely in the last quarterly result season, but this is just the beginning in the sense that we expect the earnings to gradually bottom out over the course of next 3 or 4 quarters and not to do anything great. But we expect the global growth to bottom out this year and rebound next year. As a play on the same, I think technology sector could be an interesting place to place bets on, particularly this year. With this thought and view, we've also launched a NFO, which is more global in nature, with the 70% India component, 30% global component, where we can play some of the ideas that you mentioned as well, particularly the US listed ones. Because we think from a 3 to 5 year perspective, if you take a slightly long-term view, which I think all the equity investors should take, IT services, after having seen a good round of downdraft post the supernormal earnings that we saw during COVID, is now in the phase of bottoming out, I would say, from an earnings standpoint. And as that rebounds over a period of time, we think there are better days ahead.
Okay, Trideep, we'll leave it there. Thank you very much for joining us and running us through, that perspective. Appreciate you being here today. Well, 16 or 17 points is what we have on the Nifty, 22,234. And market breadth is looking up. 1,300 stocks are higher, 1,100 stocks are lower. It's a quiet day, at least on the indices. We'll come back. We'll get you more. A quick check on what's happening in dealing rooms. Nimesh gets us that flavor. Not just the broader sort of